Welcome to Tuesday Talks at the White House. I'm Corey Shulman in the Office of New Media, and this is our first Tuesday Talk, and we're really excited about it. Tuesday Talks are a weekly invitation for people around the country to engage with policy experts and administration officials. And today we're so fortunate to be with Elizabeth Warren, who is setting up and really leading efforts behind the Consumer Financial Protection Bureau, which is one of the central aspects of Wall Street reform that the president signed in July. So we're going to jump into your questions shortly, but I will turn it over to Elizabeth to make a few opening remarks.
Good. So Corey, thank you very much for having me here. I am delighted to do this and delighted to have an opportunity to talk about the new consumer agency. You know, I went around knocking on doors for a long time to ask people to think about this consumer agency, and one of the people who thought a lot about it was the person who became the President of the United States, and said, I can get behind that one. And whoever thought in Washington terms, such a short period of time, we would now have an agency, and now we're about the business of putting the pieces together and getting this thing going. So let's see what the questions are.
Okay, so we're going to jump into some, we've been collecting your questions on Facebook all day, and we have a bunch that are rolling in live. I encourage you to go to whitehouse.gov/live for a link to jump into the Facebook chat, where we'll continue to take your questions. But we'll start with a question from Chris Bates, which is a really good question to sort of set everything up. And he asks, what exactly is your role, and how will I as a consumer benefit from your post?
Okay, fair question, Chris. My role is to get this new consumer agency off the ground, to get it up and moving and doing the things it's supposed to do. So what is the consumer agency supposed to do? Over time, it's supposed to work on credit products so that it makes it easy for you to understand what the price is, so that you can say, gee, is that how much I really want to pay here? To understand the risks associated with these credit products, and to be able to compare one to another. So you can look at 4 credit card agreements and say, oh, that's the one that's the cheaper product. That's what we're driving toward. Ultimately, it's toward markets that work for consumers by making it easy to read, easy to understand, and easy to make comparisons. I realize it's probably not the sexiest thing that will ever happen in your life, but it's one that over time is going to save you and a lot of other Americans a whole lot of money.
So this question comes from John Stephen Dwyer, and it sort of takes a step back and it reflects more on Wall Street reform generally. He asks, there's so much in it that I have trouble wrapping my mind around it, which is a fair question. Could you please explain, or try to explain in a nutshell, how it will affect the middle class American? Okay.
So the consumer agency is part of a bigger package. You're right, it's a lot of pages that start, I think of it in terms of the financial transactions. It starts at the consumer end. It starts at what's really the raw material, consumers making loans and lenders lending them. As you know, what happened was lenders took those loans, particularly in the area of mortgages and subprime mortgages. They sort of sliced them and diced them and packaged them together and kept sending them up the line, selling them and reselling them and reselling them. And by the time they got to the end, a lot of risk in the system that had started down at the family level was not just aggregated, it was actually magnified. So in a nutshell, the way I understand the Dodd-Frank bill is it starts at the front end and it says, not going to put that kind of trashy stuff into the system to begin with. We're going to make sure consumers on the front end can make good decisions about their own financial lives, that they can see those risks and appreciate those risks. And people who are planning to make big profits off surprising people, off tricks and traps buried in the fine print, that's going to go away. That means that the raw material that goes into the system basically is about more stable families that are more likely to be able to pay. It then gets picked up in the rest of Dodd-Frank in the packaging and how that's done, and how the pieces are sliced and diced, the markets on which they're sold, to try to keep risk not totally out of the system, but at least keep it under control, to keep it dialed down. And then when you get all the way to the end of the process, if we still have serious financial problems and face another crisis in the economy, we've got a systemic risk council that's supposed to be monitoring, watching, collecting information as they go along, that can step in the case of catastrophic failure. So I actually see this as a kind of A to Z effort to try to make it an overall safer financial system. And at least for me, that really starts one family at a time.
Okay, so this question comes from Trish Everett, and she asks, as a high school teacher of government and economics in these tumultuous times, how can I help my students to remain optimistic about the conditions that they will face as young adults, both as citizens and as workers, consumers in this economy?
Oh, I'll tell you what makes me optimistic, what makes me wake up every morning, so glad I'm here, is that we're going to make this better, because we can make it better. So let me put it this way. We've had a world, how about if we talk about credit, what it is, families borrow, and remember, there are good reasons sometimes to borrow money. People use it to build wealth, to start small businesses, to buy houses that they pay off and that appreciate over time, sometimes to deal with emergencies, to invest in their own education, student loans. Credit is an integrated part of how people live their lives, and when used in good ways and when they're good credit products, can help make them financially more secure. But the last 30 years have really been a kind of wild west of consumer credit, a sort of anything goes. And the lender who will sell you the product that pretends to be the cheapest while in fact buried back in the tricks and the traps are all the ways to drive up the cost. Those are the guys who've really prospered under this system. And the consequences now is that American families, many of them, are facing real economic struggles. Mortgages, we've got 50 million American families who can't pay off their credit card debts. That's pretty grim. But here we sit today with a brand new consumer agency with the tools on the table to be able to make this better. The first time we've built something for American consumers in more than 30 years. And the idea behind it is to get these markets working for young people, to get these markets working going into the future, so that over time, when you have to borrow money for a student loan, when you need to use a credit card, when you want to take out a mortgage, when that time comes in your life, it is both a safer market and a much more competitive market, which means the prices are down. All by itself, it's not everything that happens in a person's life, but this is one that we can get better over time and over a pretty short period of time. So here's where I am today with young people like your students. This is your agency. You need to invest in us. You need to be watching what we're doing, holding our feet to the fire if you think we're not doing it right, learning about what we're doing, because we're about making your future stronger. We get this one right, we can get other pieces right too. We can get government playing the right role, we can empower families to play their role, and we can get an economy that doesn't just work for a few of us, works for all of us.
I just want to remind everyone, go to whitehouse.gov/live. There's a link to Facebook, so you can hop in the chat and start asking questions for us live. So I have a question that came in a couple seconds ago from Alan Gu. The banking industry is trying to offset lost revenue due to new regulations, credit card debt, overdraft, by charging consumers additional fees on checking and other products. What are your thoughts on what the industry is doing?
You know, I have to say, this really does amaze me. There was a major financial institution that sent out a letter to its shareholders in the last quarter. And the letter said, in effect, I'm paraphrasing, but only slightly, the new laws, because remember, we've already gotten some new laws into place. The card law, for example, that eliminates some of the worst practices on credit cards. These new laws that have come into place under the current leadership have cost us $650 million this quarter. And, you know, I had this moment when I read that and I thought, one company, $650 million that they say these new laws outlawing these bad practices cost them. I kind of read that the other way. That's $650 million that stayed in the hands of American families. $650 million from just one company on just a few bad practices that were banned thanks to the work of the current Congress, thanks to the work of Carolyn Maloney, who was one of the people who really led the effort on this, thanks to the work of President Obama. So here's my view on the card or any other creditor's notion, that somehow they're entitled to a certain level of revenue, particularly a level of revenue set at a time when they're, it was kind of an anything goes world. I'm just not there. Instead, my view is, let's see what a competitive market brings us. There may be a period of time when some of the large financial institutions will do what they can to squeeze out every last nickel, to try to push harder on fees in one place because they can't do them in another. But over time, I'll tell you where this agency is driving. It is driving toward a consumer market in which products are easy to read, easy to see what the costs are, and easy to make comparisons. As we push toward that, the room for anybody in the financial services industry to make their money by squeezing you here and squeezing you there, tricking traps, that's going to go away. And I want to be clear here. I think there are some banks that are going to be glad to see that day come, and I think they're going to do very well competitively. And the banks who don't like it are the ones eventually that customers like you are going to make the difference about whether or not they survive.
Okay, we have a question from Darren Johnson. He asks, who will be regulated and who will still not be regulated? How will regulator independence and thorough enforcement be ensured? And what penalties will be enacted for violations?
Okay, so we're going to do all three of these, and if I forget one, you have to come back and help me. So the first one about who will be regulated. This is one of the coolest parts about the Dodd-Frank bill. Up to now, regulation has been fractured. There have been 7 federal agencies in Washington that had different pieces of consumer financial regulation and regulation over sometimes banks, sometimes thrifts, sometimes different kinds of mortgage lenders, different pieces. And a whole group of folks who were not regulated at the federal level at all. Sometimes they were regulated at the state level, sometimes they were just simply unregulated. They're known in the trade as non-bank lenders, and all it really means is folks who get out there and engage in putting out certain kinds of credit products, but they don't actually take deposits, so they're not technically qualifying as banks, and therefore weren't under the old regulatory structure. So, cool part of Dodd-Frank, it says if you issue the product, if you put out a student loan, if you put out a credit card, if you put out a mortgage, if you put out a payday loan, if you're putting it out there, level set of rules, regardless of whether you're a bank or a non-bank or anybody else. So we are literally right now, 3 weeks into this agency, building what's called our non-bank enforcement. And this takes me into the second question, right? Who's going to supervise them? Answer is we are. Now we're going to do it in partnership with the state attorneys general and with the folks who've already, we've had a lot of boots on the ground there, but they've been hampered and held off by some of the old federal regulators. Those days are over. So what I hope this means is we're going to have a lot of people out there working to try to enforce the rules for everyone. And I think the third question is, what are the penalties?
Yep. You
got a real wide range of where you can go. So it can be about monetary penalties. It can be about cease and desist orders. We've got pretty much the full range of what we can do. But I want to make 2 parts clear on this. The first one is, it's not just catching them after they did it. Part of this is about supervision in advance. So a big part of this agency is coming in and checking the books to make sure that the consumer laws, the consumer rules are being abided by. People are following the rules, which is really important. And a second part of it is to say, eventually, I think the American people are going to be a big part of enforcement here and a big part of making sure that this agency is not captured by powerful interests that it is supposed to regulate. So part of the architecture that I hope we're going to build into this agency, it's not just transparency, it's a real engagement with American families. This agency belongs to the people, and the people have got to have a stake in it, and they're going to be part, ultimately, of our enforcement team, part of keeping us honest, that we don't get captured by anybody else.
And for everyone that's watching, go to whitehouse.gov/live. There's a link to the Facebook chat. We're getting a lot of great questions. One question that I want to ask you, and this has come up a number of times, from Nazima, Hasham, Razik, and then also Lisa Black and a few others. They're asking what resources, what tools do they have for honest consumers that are having troubles? Where should they turn?
Well, this is a tough one right now. I would like to say, go to our website, and we have lots of things up on the website. But after 3 weeks, we're not there yet. It's going to take a while to build this agency. There are some good websites out there, and it depends in part on what the specific problems are. The different agencies have some websites. It kind of depends on where your problem is. If you've got a mortgage problem, if you've got a credit card problem, that's the problem right now, is that the whole thing is fractured. So that there is a website for the OCC. There's one for HUD, which does housing, so is at least in part involved in mortgages. FHA, there's a website with HAMP, but also I want to point out to you, in some states, some of the strongest access to help is through the state attorneys general. They are the folks who are really on the ground and watching out for consumer fraud, consumer scams. Now, I should add one more, because it depends on what this question is really about. For people who are themselves in serious financial trouble, people who are looking at potentially foreclosures on their homes, people who've gotten head over heels in debt, sometimes through job loss, medical problems, family breakups, sometimes just bad periods in the past with some bad decisions. Sometimes what it means is you need to talk to a lawyer about those, that getting wholesale advice is not always the right place to be. And talking to lawyers who specialize in consumer law, or talking to lawyers who specialize in bankruptcy law, can be a way to get some advice about the circumstances, highly individualized to the circumstances you face. The National Association of Consumer Bankruptcy Attorneys, NACBA, I'm learning acronyms, and NACA, the National Association of Consumer Attorneys, both have friendly websites that try to give some basic information and try to put consumers in touch with the attorneys who are working in their area, and sometimes that's where people need to be.
Okay, this question just came in from Zachary Baum. Is the Bureau planning to take action to address the recent mortgage foreclosure crisis affecting homeowners?
Well, so let me start by saying, if there was anyone who thought, I'm not really sure we need a consumer agency, could we just take a look at today's headlines and make it clear exactly why we should be having this agency? If we had had this agency in place 3 years ago, when it was clear there were some problems already. I've been on these listservs and conversations with people in the field for a long, long time, and it was clear 3 years ago that there were problems with the servicers. There were problems right now that we're having with affidavits and notarizations and other parts of the documentation in the foreclosure process and other parts of servicing mortgages. Back when those were small problems and far apart, this agency would have had the opportunity to come in and head them off right then. You know, little problems are a lot easier to fix than great big problems. So where we stand today, well, as everyone knows, we have major servicers saying we're going to halt foreclosures, which tells us two very important things. The first thing it tells us is that this problem is big. It is big and it is serious. The second thing it tells us is that the issuers themselves are trying to get this problem solved. And I think right now the role is to do what we can. And I don't just mean we, the agency. We're in our infancy. But the federal government generally, the different agencies, to gather information and try to get ahead of understanding what's going on out there.
Okay, the next question comes from Steph Kern, who is currently in a public policy workshop discussing this legislation. Her question is, what in your opinion on personal responsibility, what's your opinion on personal responsibility versus leveling the playing field?
I don't think they're versus each other. I think I'm in favor of both. So here's my view on this. Personal responsibility, you bet. There is nothing in this agency that is designed or will be designed to try to help people who get a credit card, go to the mall, charge up like crazy, and then don't want to have to pay their bills. That's not what this is for. What this is for is to make sure that people can see the costs and make assessments of the risks associated with credit and be able to compare the products to see which ones are cheaper and which ones are riskier, so that that market can work, so that it means something to exercise personal responsibility. Ultimately, the way I see this is a level playing field where both sides understand the deal up front, no hesitations about that. That's the one where personal responsibility really works. A world in which you think you're buying at one price and the thing is loaded with tricks and traps, that's where the whole thing gets tangled. I'm all for personal responsibility exercised on a level playing field. I think that's how we get to the right place.
Okay, the next question comes from Scott Merrim. He asks, will the Bureau merely be reactive to complaints of abuse, which due to the complexity of many of these forms and agreements may not occur as often as they should? Or will it be proactive and check out on its own on the behavior of various companies to see if they act appropriately?
Oh, proactive. So here's the way the agency, as we're designing the pieces and how it starts. The first tool, right, on enforcement is supervision. So we'll actually be out there. This agency will be out there monitoring big lenders, lenders on certain kinds of products, lenders who are engaged in certain kinds of dangerous activities, to see what they're up to and to do it on an ongoing basis, not waiting for any complaints or concerns. So that's going to be a big part of what we do. And as I said earlier, we're going to have the full range of tools. So you can do the supervision, you can try to get correction at the supervision level. If they don't want to do that, then you move to something called enforcement. The attorneys general will be part of our partners in this process. So the whole idea is to start early in the process, and particularly with the attorneys general, to have plenty of boots on the ground watching this and watching it around the country. But having said that, another critical part of what this agency will do will be hearing from consumers. And it's really about whose agency this is. It's hearing how Americans are experiencing credit. What's going wrong, what's going right, what's given concerns. I'm very hopeful that this will be a smart agency over time, sucking in a lot of information about what's happening to a lot of people across the country, a sort of crowdsourcing notion, but in the regulatory apparatus. How are people what are people telling us? How they're experiencing different parts of credit and what's going on. If we'd had that, I will say, for example, the problems that later cropped up in student lending would have been clearer a lot earlier, and changes could have been made a lot earlier. The example I just gave on mortgage servicing, problem that we could have dealt with much, much earlier. So it's going to be partly, absolutely, the responsibility of experts, the responsibility of the agency and the agency's employees to be proactive. But ultimately, I hope people don't see this as a burden. I hope they see it as a part of, because this is their agency, we're going to hear from American families, and that's going to be a significant part of the enforcement of this agency's rules.
Okay, this question comes from Pat Galligan, and he asks, can you generally elaborate on the CFPB, how it will help consumers, and also how consumers can help you?
Okay, so the central thing that this agency is going to drive toward, at least to start, where we want to push this, is to get markets to work appropriately, to get markets to work for families. That's the key idea behind it. What does it take to make that happen? Well, it doesn't take layering on another 40 pages of disclosures that nobody can understand, and nobody has time to read and nobody wants to fool with. It does not come from things that get hidden back in the tricks and traps, and so you think you're being sold something at 3.9%, but what they're really counting on is they have a lottery ticket, hoping that you will trip here or move over there, and they'll get to hit you with this fee or that increased interest rate. What this is really about is simple products, easy to tell what they cost, easy to make comparisons. Basically, a good competitive industry, not driven by tricks and traps, no place to run, no place to hide, just an honest place for families to be able to see what the costs are and decide if they want to take them on.
Okay, now this is the last question from David Hubbard, and he asks, at what point do we define economic and financial protection for the people as the prohibition of financial windfalls of large insurance companies that provide less services to customers? So he goes on to say, at what point do we penalize insurance companies that make huge profits when they provide inadequate coverage for the people that they insure?
Okay, so I need to start with this. We don't do insurance companies. Insurance companies are not within the purview of the Consumer Financial Protection Agency. What we do within the Consumer Financial Protection Agency is about credit. It's about borrowing money. It's about doing it in lots of different forms, credit cards and mortgages and check overdraft and lots of different directions. But insurance, the world still has its divisions and its expertise. Insurance is outside our fence. So I'm afraid I thought I was doing pretty good on answering most of the questions, but I'm going to have to take a pass on that one.
Got it. Well, thank you so much. We're going to keep listening to your questions, and we'll be following up and responding on whitehouse.gov. Thank you, Elizabeth, for joining us, and for everyone that's been participating in the chat online, and we look forward to seeing you next Tuesday.